Dr. Janice SETO, and I'm the instructor for this course in grade 12 accounting. And it's, what is the date? It's the 28th of July in 2015 here in this beautiful sunny Subanjaya in Malaysia. So let's go, folks. As you can see here, we're going to be covering Chapter 2 of our textbook by Harrison Horngreen, and it's financial accounting. So let's just get started. All right. So what we've been doing in our first chapter was we had an overview of accounting, especially the accounting formula, which is assets equals liabilities plus owner's equity. And we looked a little bit about ethics. And we even started our first balance sheet and income statement. We also did the financial statement changes in equity. Now, of course, everything comes about, is summarized at the end of a whole series of business transactions and activities. So in this chapter, Chapter 2, we're going to look at the different transactions that can happen in a company or a business, and we'll just take it from there. Now, in this program, Screencast-O-Matic, I'm only limited to 15 minutes, so regardless of how long the PowerPoint presentation is, this section is going to be 15 minutes. So we'll just see how far we can get in this slideshow. Alright, so transactions basically are very important to a company or any business. It affects what we own, what we owe, and are we making any money? Is this business profitable or not? So here we are. If you can see from this slide that are you selling things? And it says products, but remember, a lot of transactions happen because of services. So when you go to a bank, that's a service. So selling products and services and paying for those expenses. Remember, we were talking about lights and utilities, other types of utilities. What we're going to be leading up to is what people call the T accounts, because things happen on both sides of the transaction. Remember, assets equals liabilities and owner's equity. So if it happens to one side, it probably will impact the other side. So let's take a look. Where are we now? So again, assets equals liabilities plus owner's equity, and that is, as I say, that's the beer equation for accounting. Now it's shareholders' equity. If it's a small enterprise, an owner, then it's called owner's equity. We looked over some examples of assets in my first few days of the class, and we were concerned with the J arrow, and we remember we had cash, generate some accounts receivables, he had supplies, equipment, and prepaid expenses, including the rent. And as you can see, other companies have building, land, and inventory. Remember, we talked about Nike. And liabilities are what you have to pay out if you are the company. So you have to pay Starbucks, coffee beans, notes payables, and then accrued liabilities. So that's now, sorry. And then, of course, share equity. Shareholders' equity is basically the capital. Under it was J arrow, capital. When you're talking about a company, for example, Sony, Samsung, Apple, then they have these other factors of shareholders' equity. Remember, we looked at dividends. Dividends are profits, part of which are paid out to the shareholders. Remember, Tim Cook, CEO of Apple, pays out dividends. Steve Jobs never liked doing that. Neither does Warren Buffett of Berkshire Hathaway. And under shareholders' equities, what will increase your equity are revenues, decreases equity are your expenses. Okay. Retained earnings basically are profits that are not paid out, which forms a dividend and have use inside the company. So now, having brought up that, let's take a look at analyzing transactions. Now, in your textbook, they're using a car wash, and you can see that the transactions here are not very different from what we've seen with J arrow. Okay, so somebody, the invested money into the company. So the equity was $50,000. It puts it in the bank, and the asset account of cash therefore is increased by $50,000. You have a balance. Now it looks like they took out 40 of it to buy some land, and so that decreases the account of cash. So now it's left with a balance of 10, and land has been created, and it's 40 equals 50. So now you have the equation still balanced. You see now it looks like they've got some supplies, and you can see that they didn't take it out of cash. They created instead accounts payable, so they owe for buying supplies. So now you have the company worth more money, 50,000 plus 3,700, so 53,700. Then we've got another transaction. So the fourth transaction looks like they generated some revenue. So in the course of business of the car wash, $7,000 worth of cars were washed and paid for. So that was paid in the form of cash. Cash has gone up to $17,000, and so now you can see that the revenue's gone up 7,000. So now it's if you add all this together, it looks like it's 60,700, and it equals the assets. Two more transactions. Okay. Revenue of 3,000 was generated by the car wash. These people didn't pay yet, but they said they will, so it generated an accounts receivable. And now you can see the company is now worth even more money. So 10,000 plus 50, so 3,700. 63,700. Is that balanced over here? And now we see that in order to generate this revenue, there were some expenses. Now it doesn't itemize the expenses. I have a feeling water was one of them. It's a car wash. Maybe they have soap and people to wash the cars. So then the total expense here looks like it's 2,700. Total of the expenses. So you take that, subtract it from the 10, 7,300. And how did they pay for these expenses? So they used cash. And so everything still is in balance. A equals L plus E. Assets equals liability plus owner's equity. Oh, it looks like there's going to be even more transactions happening. So I'm just going to go quickly over, make sure how many transactions. So looks like, yes, there's more transactions. There's 11 transactions altogether, and I'll go over them. Might as well go over them right now. Alright, so let's see what happens here. So transaction, anytime there's a transaction happening, you want to figure out where it goes under, what's the proper account. Alright, so let's see what's happened here. Well, it looks like cash has fallen by 1,900, and why? Why did they take 1,900? What they've done this is they've paid off some of the accounts payable. So we owe money, and we owe 3,700, and we've paid some of it. So now we have at the end this much money that we owe in terms of our accounts payable in the liability section. Now it says here, number 8, not a transaction by the company. Let me see. Not sure what's going on there. Oh well, it's not a transaction by the company. I'm going to have to refer to your textbook. And now we have here, let's see, $1,000, and then $1,000. So it looks like accounts receivable. So somebody who owed us money paid 1,000, and so therefore they don't owe us much, and so therefore this account of cash has increased. The asset account of accounts receivable has fallen. Okay, now let's see what's happening here. Land. Okay. Sorry, I can see what's happening up here. land has fallen by 22,000, and the cash has gone up 22,000. Okay, so it looked like maybe they sold a parcel of the land, so they subdivided the land and sold part of it. So therefore, the land that's still retained in the company that you own is now the value of 58,000, and the cash has increased. All right, that's nice. And then the last transaction here is dividends. So remember profit. So out of the profit, 2,100 of that profit was paid out to the shareholders of this business. It was paid out in the form of cash. Alright, so that was a very quick overview of some of the transactions. And let's take a look at the next slide. And so what's happened is, in this slide, they've taken everything in these two slides, they've just stripped out the blue portion. And so what we have left is basically what happened at the end. So you've got the balance sheet assets, the column, and then the liabilities and owner's equity, this half, in perfect balance, 57,000 and 57,000 here as a result. So you can see why when we're doing accounting, I say accounting's really easy if you focus, you don't rush, take it one at a time. I know some students like to get together and study. I think that's great. It's a good idea to do it first on your own, and then get together and compare your results. Do it in a caring, supportive atmosphere in which nobody says to anybody else you're stupid. And then I think that you'll have great success in mastering accounting. So remember, take it slow, analyze these, and just give it make sure you focus your attention. Give your cell phone a break and give yourself to accounting. So we've just finished this section of the PowerPoint in Chapter 2, and we'll see you next time.